Welcome to Kenyan Market Daily podcast. Today we're doing a deep dive, really getting into the pulse of Kenya's markets and the economic headlines that are truly shaping things right now.
Exactly.
Think of this as your essential briefing. We'll cut through the noise, the jargon, to deliver the insights that genuinely matter for you.
It's an incredibly dynamic period, host.
Yeah.
And what's particularly insightful right now is seeing how deeply intertwined our local market performance is with, well, broader global events. We'll be connecting some crucial dots for you today, helping you move beyond just the daily numbers to really grasp the bigger picture. Why these shifts and these news stories actually have real implications.
Okay, so our mission today is pretty clear. We're going to first dissect the recent movements on the Nairobi Stock Exchange, then we'll zoom in on some specific companies, look at the expert recommendations for their stocks. After that, we'll broaden our view, explore how significant global events and, domestic policy decisions are rippling through Kenya's entire economy. Okay, let's get straight into it.
Let's do it.
All right, let's start right there. At the heart of it, the Nairobi Stock Exchange. Looking at the latest market summary, we're seeing a fascinating blend of signals.
Definitely.
On one hand, the equity turnover, which tells us the total value of shares traded, well, it saw a pretty significant drop, plummeting by 69.2% to KES 275.26 million. That's way down from KDS 892.27 million in the previous session.
Huge drop.
Yeah, a huge reduction in trading activity.
It is indeed a noticeable drop in turnover. But here's where it gets interesting. Despite that lower trading volume, the overall market capitalization, basically the total value of all listed companies, it actually nudged up slightly by 0.9%, reaching KDS 2,273.45 million. Now, this is subtle, but it's an important indicator, I think. It suggests that while fewer shares might have been changing hands, the value of the market as a whole kind of held its ground, maybe even gained a bit.
Okay.
It signals a sort of quiet resilience, perhaps, a cautious holding pattern, maybe, rather than a big market sell-off.
That's a really interesting contrast. When trading activity slows down that much, yet the market cap goes up. What does that tell us about investor sentiment? Are we seeing, cautious optimism, or is it just the market holding its breath?
That's a perceptive question. And if we connect this to the bigger picture, the indices actually seem to reinforce that underlying resilience you mentioned. The Nairobi All-Share Index, the NASI, it continued its bullish momentum. It rose by 0.9%.
Okay.
And it wasn't just NASI. The NSE 10, the NSE 20, and the NSE 25 indices also recorded gains right across the board. 0.4%, 0.7%, 0.4% respectively.
So pretty broad then.
Exactly. It indicates that the positive sentiment wasn't just isolated to a few specific stocks. It was fairly widespread across different market segments, which suggests a more fundamental, albeit maybe cautious, upward trajectory.
Right. So given that broad positive feeling, what specifically drove these movements, especially in those large cap stocks? Which companies were the real movers and shakers today?
Well, the equities highlights show that gains in some of our heavyweights were certainly key to those index movements. We saw Diamond Trust Bank rise by a solid 4.2%.
Wow, okay.
Safaricom Paldic gaining 2.2%. KCB Group up by 0.5%. And HF Group saw a modest 0.3% increase.
Okay, so some definite positives there.
Definitely. But it wasn't all green on the screen.
Yeah.
Some prominent companies did weigh down performance a bit. East African Breweries, for instance, declined by 0.8%, Equity Group by 0.4%, ABSA Bank down 0.3%, and Standard Chartered dipped slightly by 0.1%.
Right.
So it's a bit of a mixed bag, really. Some pulling up, others dragging slightly.
Understood. And what about foreign investor participation? Did they contribute to this resilience, or was their activity maybe telling a different story?
That's a critical point to look at. While foreign investors did remain net buyers, which is positive, recording inflows of KES 4.82 million.
Okay, still buying.
Still buying, yes. But this was a sharp decline from KES 169.25 million in the previous session.
Oh, wow. Big difference.
A very big difference. This significant drop in foreign inflows, even though it's still net positive, it does raise an important question, doesn't it, about their broader confidence, perhaps. Or maybe it's a reaction to some of those global uncertainties we'll touch on later.
Could be.
It might suggest a temporary pause in their enthusiasm, perhaps. And speaking of enthusiasm, or at least activity, Safaricom Paldic remained the most actively traded counter. Turnover of KES 55.56 million.
Always Safaricom.
Almost always. Followed closely by Equity Paldic at KES 52.79 million. So these two continue to dominate trading activity. That's where a significant chunk of market liquidity and, well, interest lies.
That concentration in just a few dominant players is always a key takeaway.
It really is.
Now, let's pivot to something truly critical for those of you trying to make informed decisions. What are the experts recommending for specific company stocks right now? Our sources provide some detailed analysis looking at current prices, target prices, and the fundamental why behind the buy, hold, or sell advice. Let's focus on a few compelling examples to give you a clearer picture.
Good idea.
Okay, let's start with East African breweries. The recommendation here is a BUY. Their current price stands at KES 186.25 with a target price set at KES 211.42. That suggests a pretty healthy upside, 13.5%.
Decent upside.
Yeah, and the reasons for this positive outlook seem quite robust. Our sources highlight resilient demand levels across their entire product portfolio. That's crucial. Their current ratio, that key measure of short-term financial health, has also moved into what's considered safety territory.
Okay, good sign.
Basically, they have ample assets to cover their immediate liabilities. Plus, internal cost indicators point to increased efficiency, and there's an expected recovery in consumer spending that should further drive their sales growth. Lots going for them, it seems.
And what's particularly compelling about EABL's recommendation, I think, is that it's not just banking on future consumer spending. The company has demonstrably strengthened its operational efficiency and its balance sheet.
Right. They've done the work internally.
Exactly. This proactive internal work positions them robustly.
Yeah.
So they're not just, waiting for external conditions to improve. They're actively building a stronger foundation themselves.
That's a really great point. Okay, now let's look at Diamond Trust Bank, or DTB, another BUY recommendation here. Current price is KES 34.2A, target price KES 39.01. That indicates an impressive potential upside of 14.1%.
Even better than EABL's potential.
Slightly, yeah. So what's driving this optimism? Our sources point directly to their digitization initiatives. These efforts, coupled with broader operational efficiency improvements, are expected to support their margin expansion.
Makes sense.
Essentially, moving more services online and streamlining processes is making them more profitable. Furthermore, their loan book expansion is expected to be significantly driven by digital lending platforms, specifically mentioning Timis.
Yeah, the DTB recommendation really exemplifies a key trend we're seeing across the Kenyan financial sector, the sheer power of digital transformation.
Absolutely.
Their focus on platforms like Timiza isn't just about convenience for customers, it's about reaching new segments, expanding their lending capabilities much more efficiently. And that's a powerful engine for growth in today's market. It really underscores how technology is fundamentally reshaping banking.
Definitely. But of course, not every recommendation is a buy. Let's look at WPP Scan Group. Here, the recommendation is a HLD.
Okay.
Their current price and their target price are both KES 2.51, meaning, while no immediate upside is projected, the reasons for this more cautious stance are quite clear, and they highlight challenges within their specific sector. The loss of key clients is expected to limit their revenue growth.
That's tough.
Yeah. They're also facing stiff competition within the advertising agency business, and there's this general trend of businesses reducing their advertising spending, which naturally directly affects their revenues. It just seems like a tougher environment for them right now.
Yeah, the WPP Scan Group case offers a valuable counterpoint, doesn't it? It highlights that even strong brands can face headwinds when those fundamental market dynamics shift, like businesses tightening their belts on ad budgets. It's a clear signal about the broader economic climate impacting specific industries. And just quickly, we also have BUY recommendations for INM Group and ABSA Bank, both looking strong due to strategic expansion and improving asset quality. But, for the sake of time, we've focused on these key examples today.
Right, and listeners can find full details on all the analyzed companies in the show notes, correct?
Absolutely. They're all there.
Perfect. Thank you for that. That deep dive into company specifics is incredibly valuable. Now let's shift our focus and try to connect these market movements to the bigger picture. The Nairobi Stock Exchange doesn't operate in a vacuum, does it?
Not at all.
Kenya's economic landscape is constantly being shaped by both external and internal pressures. And one of the most significant external pressures right now seems to be the escalating Israel-Iran conflict.
Indeed. This conflict has profound implications far beyond the immediate region, and our sources really highlight how it's putting Kenya's crucial government-to-government fuel deal to the test. This raises an important question. What are the specific channels through which this conflict could actually impact us here in Kenya?
That's the critical point, isn't it? Our sources detail that attacks on energy infrastructure and potential traffic disruptions through the Strait of Hormuz, which crucially handles about a third of the world's seaborne oil and gas, could lead to increased fuel prices globally.
A major choke point.
Exactly. For Kenya, this directly impacts our renewed contracts with major suppliers like Saudi Aramco, Emirates National Oil Co., and Abu Dhabi National Oil Co. Higher fuel prices here would just ripple through our entire economy, increasing transport costs, production costs for businesses, and ultimately, consumer prices for everyone. It's a direct vulnerability.
And this external pressure brings us to a critical point regarding domestic policy and specifically revenue generation. The Finance Committee of the National Assembly has, for a second time now, rejected the proposal to grant the Kenya Revenue Authority, the KRA, unrestricted access to taxpayers' personal data.
Right, I saw that. Privacy concerns again?
Mostly, yes. Driven largely by those privacy concerns, despite the state's stated aim to, weed out tax cheats. The KRA currently has limited access. They can integrate systems with third parties like banks and telcos, but crucially, without accessing personal data or trade secrets. It's that classic push and pull, isn't it, between the government's need for revenue and citizens' right to privacy.
It really is, and it's not the only revenue challenge the government's facing, is it?
No, it isn't.
Another significant development on the revenue front, MPs have also reversed a proposal to make certain vital products VAT exempt. The National Treasury had hoped to raise an additional, what was it, Sh3 billion?
That's the figure, yes. Sh3 billion through the Finance Bill 2025.
By shifting 7 products, things like locally assembled mobile phones, electric bicycles, solar batteries, electric buses from zero-rated to exempt status. This rejection is a significant blow to the government's revenue enhancement plans.
It is. It means they'll need to find that Sh3 billion somewhere else, or perhaps adjust their spending plans. A real headache for the Treasury.
Absolutely.
And what's truly sobering, I think, and directly impacts everyday Kenyans, is the state of the job market right now. A recent Central Bank of Kenya survey, quite comprehensive, polling over 1,000 CEOs, reveals what looks like a deepening job crisis.
Oh dear, what did it find?
Nearly a quarter of firms, both in manufacturing, that's 23.5%, and in services, 23.9%, have actively cut full-time jobs in just the last 3 months.
A quarter, that's huge.
It's a very significant number. And why? Primarily, they say, due to weaker demand for goods and services. Now, in stark contrast, only a really small percentage, 11.8% of manufacturers and 10.9% of service firms, actually increase their full-time workforce.
Wow.
It highlights a major challenge in the current economic environment, reflecting directly on the cost of living and, well, household incomes for so many people.
That 23.5% job cut figure in manufacturing, that's truly sobering. But on the statistics, like you say, that represents real families feeling the pinch. Is there any, I don't know, silver lining or positive news on the corporate side? Perhaps a company managing to navigate these challenging waters successfully?
Well, there is actually. On a more positive note, for one specific company, our sources indicate that Sanlam Kenya has successfully repaid an outstanding Sh 2.4 billion loan they had with Stanbic Bank Kenya.
Oh, good for them. How did they manage that?
They achieved this by using funds from a recent Sh 2.5 billion rights issue. Now, this debt, it previously stood at a substantial Sh 3.04 billion back in December 2024, and it had even been restructured 3 times.
So it was a heavy burden.
A very heavy burden. But it was fully settled on May 23, 2025. And the CEO stated that the insurer is now, quote, adequately capitalized for growth without new debt.
That's a strong statement.
It's a very strong signal for their financial health and their future prospects. It really shows the company aggressively addressing its liabilities and positioning itself for stability, which is great to see.
That really is a fantastic piece of news for Sanlam Kenya, a genuine turnaround story in tough times. Now, expert, let's zoom out even further if we can and consider the global market. While our primary focus is obviously Kenya, these global currents inevitably create ripples that reach our shores. What are we seeing on the international stage?
Indeed. And looking at the major global indices, it's a bit of a mixed bag, as you often find. Bearish sentiments were quite pronounced in the U.S. and German markets recently. The S&P 500 declined by 0.8%, and the NASDAQ Composite, which is heavily weighted with those tech stocks, fell by 0.9%.
What's driving that, primarily?
Well, the decline seems largely driven by renewed global uncertainties, particularly stemming from those escalating tensions in the Middle East we discussed earlier. With leaders adopting sort of hardline positions that are likely to prolong the conflict, that creates nervousness.
Understandable. What about Europe and Asia?
In Europe, the UK's FTSE 100 saw a slight rise, 0.2%, while Germany's DAX fell by 0.4%. So a mix there, too. Asia presented a more varied picture. Japan's Nikkei 225 rose by 0.9%, quite strong, but China's Shanghai Composite remained relatively unchanged. flat.
Okay. And what about some of the individual global stocks that maybe stood out in terms of activity or movement?
Well, we saw Intel Corporation drop significantly by
Oh,
10.0%.
ouch.
Yeah. And Tesla Inc. was down 3.9%.
Mm.
On the flip side, Advanced Micro Devices, AMD, saw a modest gain of 0.7%. So this mix reflects specific industry pressures, alongside that broader market sentiment.
Right. So bringing it all back home,
Yeah.
what does this all mean for you or listener here in Kenya? How do these global shifts ultimately connect back to our local market and maybe your everyday life?
That is the crucial question, isn't it? And the connections are very real. The Middle East tensions, for example, they directly influence global oil prices and supply chain stability.
Like we talked about with the fuel deal.
Exactly. As we discussed, this directly impacts Kenya's fuel deal and energy costs, which then filters down to consumer prices, business operations, even inflation right here at home. Similarly, the performance of major economies and global tech giants like Intel or Tesla can influence foreign investment flows into emerging markets like Kenya. That affects our own market liquidity and investor confidence.
So it all ties together.
It really does. Understanding these global dynamics provides absolutely crucial context for our local market. It helps you anticipate potential impacts rather than just reacting to them.
What a deep dive indeed. We've truly navigated a complex landscape today, haven't we? We started with that fascinating interplay between bullish momentum and decreased turnover on the NSE, looked at specific company recommendations, the detailed reasons behind them, and then unpacked the profound impact of global conflicts and domestic policy decisions on Kenya's economy, and crucially, the job market. The interconnectedness of all these factors is truly remarkable.
If we connect all this to the bigger picture, it becomes abundantly clear that in today's, let's face it, volatile markets, information isn't just power. It's about gaining clarity,
Hmm.
understanding the why behind the numbers, and how these global forces ripple through our local economy allows you, the listener, to think critically about investment decisions, about economic resilience, even about your personal financial planning. And this raises an important question maybe for you to consider going forward.
What's that?
How do these market and economic insights inform your own outlook on the future, whether that's for your personal finances, your business, or simply your understanding of broader societal trends here in Kenya? Something to reflect on.
That's a great final thought. We truly hope this deep dive has given you a clearer, more informed perspective on the powerful forces shaping Kenya's economy today.
We hope so.
If you found this discussion valuable, please make sure to subscribe to Kenyan Market Daily podcast wherever you get your podcasts. That way you won't miss any of our upcoming deep dives.
Definitely subscribe.
And you can also follow our channel on all the socials. The links are conveniently placed right there in the podcast description. Until next time, stay curious, stay informed, and keep digging deeper.